Hello and welcome to a fresh new edition of Bazaar Morning Call. I'm Prashant. With me, my colleagues Reema and Nigel. Good morning, guys.
Hi, good morning.
Starting this Wednesday with slightly lower cues, lower market cues. And there is an important event ahead as well. And that is basically the market awaiting the Fed Chair Powell to speak. In the past, he's caused ripples, he's caused earthquakes. Will he do the same today? That's the question. Yields and dollar are higher a little bit. I mean, equity markets, not really very much. I mean, just flat to slightly lower. That's the picture in terms of S&P and the Nasdaq. SGX Nifty is indicating about a 16, 17 point lower start. But, the last few days, we've noticed a sense of loss of momentum in the market, right? It's not pushing through. You want the market to take out new highs and then build on it, which has not been happening. Reema.
Indeed. For the last 2 days, after hitting fresh record high levels, we've slipped towards the end of trade. But you're right, U.S. markets struggled to bounce back after Monday's sell-off of close to about 1.5%. It was largely a quiet sort of a day. The markets shopped around ahead of that highly anticipated Jerome Powell speech. A quick word on the kind of flows that we had. The FIs bought 1,241 crore in the cash market. The DII sold nearly 744 crore. This would make it the fourth consecutive day of a net institutional buy figure. Month to date, this is the last day of the month of November. That's the picture. The FIs have pumped in nearly 13,500 crore rupees, while the selling by the DIs has been 2,200 crore. In fact, in this calendar year, so far, only in the month of August had we seen selling by the DIIs. And if the picture continues, November would also be a month where the DIIs would be sellers in the cash market. But Prashant, what's the setup? As you said, right, you're seeing some signs of a fatigue. That euphoria is missing to push higher.
I mean, the euphoria is missing, absolutely, right? I mean, we were talking about this on the day that the market made a new high as well, and I think that is the same now as well. So just a couple of points. The big important event, of course, will be the fact that, Fed Chair Powell will speak later today. And I think that is kind of important to note. The reason why that is important is essentially because the last time, first of all, we've not heard from him since our last Federal Reserve policy meeting. Number two, on previous occasion when he's come out and spoken, he's caused, big moves in markets, the dollar, the equity markets, etc. The last, of course, was Jackson Hole, which caused that big shift in terms of market expectations. The general expectation, the base case is that he's not going to do any of that. He's basically perhaps indicate that a downshift in the pace of rate hikes is coming. That is one. But at the same time also emphasize that we are not there yet in terms of sort of wrapping up rate hikes. There is more to go. Another 15 December, maybe another 15 early next year. And then, a couple of 25 basis point rate hikes. So in terms of affecting market pricing too much, that may not happen. In any case, I think you'll need to kind of let this event pass. You don't want to preempt it in any way. You just have to look at, James Bullard and what he said in the reaction he caused in the U.S. market just on Monday, earlier this Monday. So that's the reason why I'm saying that be mindful of hawkish risks as well, especially because the market has come up so much over the last couple of days. Here in India, I want to say that over the last couple of days, we've seen some sort of loss of momentum, and I think that has been very, very evident. Yesterday, for example, banks were lower, mid-caps and small-caps ended lower as well. I mean, the mid-caps and small-cap part of the market was down 0.75%, maybe a little bit more, and that's broader market. You want the market broadening, not narrowing, which was the case last few days, but I mean, it just kind of abruptly ended yesterday with that pullback. Market breadth has been narrowing as well. FII net long positioning at some 90,000 contracts is at an extreme, is at a bit of an extreme. This is data point that I put out last Friday on Editors Roundtable as well, cautioning that, this is indicating that, extremes are never good, either long or short. We are at a position where FI net long positioning is at an extreme. It's not indicating a reversal. For that, you need confirmation from price action, which is not there yet. In any case, if you're trading, yesterday's high of 18,678 becomes important. It could act as a bit of a resistance. And the 18,450 kind of area is the support on the downside. That's broadly the area, 18,400, 450, from which the market kind of bounced and broke through into new higher levels. So that's the picture. SGX is in any case indicating a flattish kind of start. Nigel, what are you watching?
Well, the big question is this long trade on the Nifty becoming too cozy for comfort? And maybe the sense is yes. Because you'd look at it yesterday, then you'll say the Nifty ended higher. But what did well yesterday? A couple of those defensive sectors. You had the FMCG index, you had the pharma index that was higher. And the breadth of the market continued to struggle. So both those two indices did well. You look at the Nifty, it said it was a great day. You look at the mid-cap and small-cap indices, you'll say, well, it wasn't that great a day. The Nifty ended higher yesterday, but the India VIX didn't cool off. That's something that we should be tracking as well. Remember, the VIX has come down, drastically. It's at multi-month lows. But yesterday, in fact, you did see the VIX as well move up with the Nifty, which normally, is not what we normally see. Now, the FI positioning on the long side and the client positionings, well, they are net short. And yesterday, they added close to 5,000 long contracts. That's in the ratio of close to 4 longs to 1 short. So let's just pull up the FI, the DI, and the client positioning. The FIs are drastically net long on the index, while the clients, after a while, well, they're getting net short on the index, and the DI positioning as well is net short. And why the client positioning is something that we're highlighting? Because in June, when the markets went to the all-time lows, well, they were long. And we know what happened from there. So the clients, well, they have been getting things right. That's the big family offices, the HNIs as well out here. And you'll have to back them, right? Because they have been getting things right. So for the first time after a long while, they're around 52% of their positioning on the short side. We'll track that closely. Remember, when in fact we went down to those June lows, the FI short positioning, well, it had gone to 87%. So they got it wrong at that point of time. Moving to the options data, yesterday saw the 18,600 put and the 18,700 call. Both of them were very active in trade. But the highest open interest is at the 18,500 put. So plugging in these levels then, the 18,700 call, well, that's how a fair bit of open risk build up. Premiums around 25-30 rupees odd. So the resistance level will be 18,700 to 18,730. On the downside, the 18,500 put has the highest open interest. The premiums in the vicinity of around 25 rupees again. So 18,450 to 18,475, that becomes a bit of a support zone. For starters, the SGX Nifty is suggesting a bit of a downtake. I don't think we're going to see any big correction, but maybe some bit of consolidation, a bit of pullback, well, that'll be par for the course. Prima, what else?
Well, just to wrap up with the domestic cues that you need to track today. One, the Q2 GDP, which will be out at 5:30 p.m. India. The MSCI rebalancing adjustment will also take place today. And tomorrow, of course, will be the auto sales. But let's get through what wise men have to tell us this morning. Mahesh Nandarkar of Jefferies believes the developed world phenomena of rising rates impacting growth through a slowdown in property markets and corporate spending will not happen in India. He says the Indian property cycle has a multi-year pent-up demand and is more dependent on pricing sentiments instead of mortgage rates. He says corporate sector leverage is at a cyclical low and corporate spending will likely rise. He says India's GDP growth should at best witness a marginal slowdown due to rising rates.
Some money market views as well. Kunal Sudani of Shinhan Bank says the US 10-year Treasury yields accelerated as Fed policymakers see no halt in rate hike culture in the near term. He says Fed Chair Jerome Powell will be expected to reaffirm the Fed's unwavering commitment to tackling inflation. He says it is important to continue to watch the dollar CNH pair movement to track behavior in the rupee. For the dollar INR, he says 81.45 acts as a support while 81.90 is a resistance.
On the bonds, Dhaval Dalal of Edelweiss says Indian government bonds have remained largely range-bound as market participants await cues from the RBI MPC on their outlook on growth, inflation dynamics in Q4 FY23. He says lower energy prices, stable USD INR has supported sentiment. A smaller rate hike will likely push the 10-year benchmark bond yield lower to 7.2%.
Well, we have a lot of stock-specific action that we'll be tracking for you. We'll get to that in just a bit. In our special Top 10 segment, we're looking at Zomato, Gland Pharma, Biocon, Zydus Life Sciences, Gujarat Fluorochemicals, Inox Wind as well as Inox Green. They are stocks on the back of positive news flow. While on the flip side, you have Interglobe Aviation, Lupin, and GR Infra. They could be stocks that could be reacting to a bit of negative news flow.
All right, Gary.